All right, let's get straight into it. We're going to build a solid, practical guide to make sure your finances are ready for whatever 2026 throws at us. Because look, with the right plan, your money doesn't have to be a victim of uncertainty. Does this feel a little too familiar? You know, prices for everything just keep climbing, interest rates are all over the place, and it feels like your financial stability is on shaky ground. And you're not alone in feeling this way, but just worrying about it? Well, that's not a strategy. And that's the big idea right here. We're not going to panic, we're going to plan. We're going to swap out that financial anxiety for a clear set of strategies so you can feel confident and prepared. So, let's start with a really simple question. Why are we even talking about 2026? What makes this year so critical for our money? Well, let's take a look at the big picture.
So, when you look at what's happening globally, you see a few risk factors starting to pile up. The OECD is flagging that things like tariffs and geopolitical drama could really slow down growth. And then you have a Reuters report warning that a fractured global economy could actually send inflation creeping back up. So what's the bottom line here? The fight against inflation, it's definitely not over.
And that, of course, has a huge knock-on effect on borrowing. The Financial Times is reporting that those rate cuts we've all been hoping for might not last as long as we think. This means, yeah, borrowing could get a little cheaper for a bit, but there's absolutely no guarantee it'll stay that way, which makes taking on debt a very tricky game. But, you know, it's not all doom and gloom. There's a potential upside here, especially if you're looking at the Indian market. JP Morgan has put out a forecast that the Nifty 50 could hit 30,000 by 2026. Now, and this is a really big now, that kind of growth is probably only going to benefit the disciplined investors. Put it this way, 2026 could be a financial roller coaster, and our goal is to make sure you're strapped in and ready to come out on top. So, the big question, how do we get ready for that ride? Well, it all comes down to a playbook. 5 core strategies to not just protect your money, but to help it grow. All right, first up, your emergency fund. It's time for an upgrade. 6 to 12 months of living expenses is still the gold standard, but just letting that cash sit in a regular old savings account, in this environment, that's a losing game. Your emergency fund needs to work for you. So you should really consider things like liquid funds or sweep-in FDs, instruments that can give you better returns to help fight back against inflation.
Second, let's talk about rebalancing your portfolio. When things are uncertain, your portfolio needs to play both defense and offense. That means shifting some focus to more stable things like large cap index funds, government bonds, and gold ETFs, and at the same time, maybe reducing your exposure to the really volatile small caps or any big real estate commitments that could tie up your cash.
And this just perfectly sums up what Ray Dalio always says. It's not about trying to avoid risk altogether. That's impossible. It's about allocating it wisely so you're protected but still have room to grow. Okay, strategy number 3 is a big one, debt. Honestly, the biggest financial mistake you could probably make in 2026 is taking on loans you don't need. Your focus should be on paying down that high-interest debt first. And don't even think about refinancing unless the new rate is a major improvement. And please, avoid new long-term debt unless your income is rock solid.
You've got to listen to Dave Ramsey on this one. His advice is timeless, but for 2026, it's more critical than ever. Debt is the enemy of financial freedom. You really have to treat it that way.
Now, this next strategy is absolutely crucial. See, inflation doesn't just make things more expensive, it silently makes your salary worth less. To protect your purchasing power, you've got to build new income streams. This could be anything. Freelancing, looking into new AI-assisted ways to earn, maybe some part-time consulting, or even investing in assets that pay you dividends.
And I mean, who better to learn from than Warren Buffett, right? His advice to never depend on a single income is more relevant today than ever. Diversifying your income is every bit as important as diversifying your investments.
And finally, let's rethink your budget. That classic 50-30-20 rule, it might be a bit outdated for a high inflation period. A much smarter model for 2026 could be the 60-20-10-10 rule. That's 60% for your absolute essentials, a really strong 20% for investments, 10% for savings, and just 10% for lifestyle. This model forces you to prioritize growth and stability over just spending.
Okay, so theory is one thing, but what does all this look like in the real world? Let's quickly run through a few scenarios to see what happens when these strategies are put into action, or when they're ignored.
So first, let's take a look at Rohan.
He had 5 lakh rupees sitting in a savings account earning a measly 3% interest. But with inflation humming along at 5%, the real value of his money was actually going down by 2%. He was losing money, losing purchasing power without even realizing it.
Now, on the flip side, you've got Anita. She invested her money in a smart, diversified mix of assets. Sure, she saw some ups and downs in the short term, but by spreading her risk, she achieved long-term stability and growth. She actually protected her wealth from being eaten away by inflation.
And our last story, a real cautionary tale, is Suresh. He bought a car with a floating interest rate loan. When an unexpected rate hike hit, his monthly EMI suddenly shot up, and his entire budget just fell apart. It's a textbook example of how dangerous variable rate debt can be when the economy is unpredictable.
Okay, so now that you've got the playbook and you've seen what can happen, what's your next move? Well, to stay ahead of the game, you need to keep your eyes on a few key economic signs.
You're going to want to keep a close eye on these rate announcements from the RBI and the Fed, the monthly inflation numbers, any news about global trade, energy prices, company earnings reports, and of course, what's happening with the job market. These are the signals that will tell you when you might need to adjust your plan as 2026 unfolds.
Look, the outlook for 2026 might be a bit fuzzy, but your financial plan doesn't have to be. With the right strategy, you can absolutely build a future that's recession-proof. The most important thing is just to start. So I'll leave you with this question. What's the very first step you're going to take?